Markets are closed right now. Silver is not trading. And between now and 6 p.m. Eastern on Sunday, when COMEX electronic trading reopens, one headline could decide whether silver gaps higher, breaks lower, or stays trapped in the same violent compression zone it has been sitting in for days. And that headline is not going to come from a chart. It is not going to come from some moving average. It is going to come from Washington, Tehran, or the Strait of Hormuz. That is why this weekend matters. Because by the time silver opens again, you are not going to have time to figure out what the move means. You are going to need to already know exactly what you are watching, exactly why it matters, and exactly what each outcome means for silver. As of Sunday, May 31st, silver is still sitting in the mid-$70s. July silver futures were recently quoted around the $75 to $76 area, after another volatile week where the surface looked calm, but underneath the market was completely coiled. That is the mistake a lot of people are making right now. They see silver barely moving for a few sessions and assume nothing is happening. But that is not stability. That is compression. That is a market holding its breath in front of three unresolved catalysts: the Iran ceasefire and Strait of Hormuz situation, the inflation data that just came in hotter than expected psychologically, and the Fed meeting coming June 16th and 17th. Any one of those can move silver. All three together can completely reprice it. The first and most important piece is still Iran. Reuters reported Friday that oil fell more than 2% on hopes for a U.S.-Iran ceasefire agreement, with Brent settling at $92.05 and WTI settling at $87.36. That matters because oil is the pressure point that has been choking silver's monetary engine. When oil spikes, inflation expectations rise. When inflation expectations rise, the Fed cannot turn dovish. When the Fed cannot turn dovish, real yields stay elevated. And when real yields stay elevated, silver gets punished every time it tries to break out. That is the trap silver is in right now. It is not that silver's long-term thesis is broken. It is that one half of the thesis is temporarily jammed by energy-driven inflation. Here is the binary setup. If the ceasefire becomes real, if the Strait of Hormuz reopening becomes credible, and if oil keeps falling toward the high $80s or low $80s, silver can rip higher fast. Not because traders suddenly discovered silver, not because the industrial demand story changed overnight, but because the market would immediately begin pricing the end of the energy shock. Silver does not wait for the next CPI print to move. Silver moves the moment the market believes the inflation impulse is fading. That is why a confirmed deal or a confirmed reopening of the strait matters so much. It restarts the monetary engine. And if silver gets its monetary engine back while the industrial deficit story is still intact, then the mid-$70s does not look like resistance. It looks like a launch pad. But the other side is real too. If the deal falls apart, if Iran rejects the terms, if Washington walks back the optimism, or if traffic through the strait remains restricted longer than expected, oil can reverse violently. And if oil reverses back toward $100, silver can lose the mid-$70s very quickly. That is the risk. A lot of silver bulls do not want to talk about it, but you need to understand it. Silver can be structurally bullish long-term and still get hit short-term if the macro setup turns against it. If energy prices spike again, inflation expectations rise again, rate cut hopes get pushed further out, and the Fed has even less room to ease. That is how silver gets dragged back towards support even while the long-term supply story stays bullish. The second piece is inflation expectations, and this is where the setup changed since the last script. The preliminary University of Michigan data had looked slightly constructive because one-year inflation expectations appeared to ease, but the final May reading did not confirm that relief. The final reading showed one-year inflation expectations rising to 4.8% from 4.7% in April, and long-run inflation expectations rising to 3.9% from 3.5%. That is not a small detail. That is the part of the report the Fed cares about, because once consumers start believing inflation is going to stay high, inflation becomes harder to kill. It affects wage demands. It affects spending behavior. It affects how aggressively the Fed believes it needs to lean against the economy. So silver now has a cleaner but more dangerous setup. Oil is falling on ceasefire hopes, which helps silver, but consumer inflation expectations are rising, which hurts silver. That is why the next move is so explosive. The market is being pulled in both directions at the same time. The third piece is growth. Q1 GDP has now been revised down to 1.6% annualized from the original 2.0% estimate. Initial jobless claims also rose to 215,000 for the week ending May 23rd. On their own, those numbers are not catastrophic. But inside this setup, they matter because they tell you the economy is not accelerating strongly enough to absorb a prolonged energy shock without pain. That is the stagflation cage silver is trapped in. Growth is slowing, inflation psychology is rising, and the Fed cannot easily rescue the market without risking another inflation wave. That is why silver is not trading like a simple safe haven asset right now. It is trading like a metal caught between two engines. Silver has two engines. The first is the monetary engine. That is the safe haven, hard money, anti-cash engine. It loves falling real yields, a weaker dollar, and a Fed that is moving toward cuts. The second is the industrial engine. That is solar, electric vehicles, AI data centers, electronics, grid build-out, defense demand, and every major technology that needs silver because silver has unmatched electrical content. In the perfect silver bull market, both engines fire at the same time. That is when silver does not just rise, it reprices. That is when the move becomes violent. That is when people who waited for the perfect entry suddenly realize the market already left without them. Right now, the industrial engine is still running. It may not be running at full speed because higher energy costs and macro uncertainty are pressuring manufacturing, but it is not off. The structural deficit story is still there. Mine supply cannot simply surge overnight. A large portion of silver production comes as a byproduct of other metals, which means higher silver prices do not automatically create immediate new silver supply. Industrial demand is still tied to long-term trends that are not going away. Solar is not going away. Electrification is not going away. AI infrastructure is not going away. Grid upgrades are not going away. The industrial engine is still alive. The problem is the monetary engine. The monetary engine has been fighting silver ever since oil became an inflation problem again. Every time silver tries to move above the high $7 the market asks the same question. Can the Fed actually get dovish in this environment? If the answer is no, silver gets pushed back down. That is the ceiling. Not demand, not supply, not the long-term story. The ceiling is real yields and Fed expectations. That is why the Iran headline matters more than anything else right now. If the energy shock starts fading, the Fed path changes. If the Fed path changes, the dollar and real yield pressure changes. If that changes, silver's monetary engine turns back on. And when both engines fire together, silver is not a mid-$70 story anymore, it becomes a ratio compression story. Gold has already done a massive amount of work in this cycle. Silver has lagged because it is more volatile, more industrial, and more sensitive to the Fed. But that is exactly why the catch-up move can be so violent. When silver starts outperforming gold in a metals bull market, it does not usually do it politely. It compresses the gold-silver ratio fast. And if gold stays elevated while the ratio compresses, silver can move much further than people think is reasonable. That is how you get the big silver targets. They are not magic. They are gold strength plus silver catch-up plus structural deficit plus speculative leverage all hitting at the same time. So what happens when silver opens? There are really three scenarios. Scenario 1, the ceasefire gains credibility, the straight reopening becomes more believable, oil keeps falling, and silver opens strong. In that case, the first level to watch is not just $76 or $77. It is whether silver can reclaim the upper $70s and start attacking $80 with volume. If silver clears $80 on a real macro shift, then the market starts looking back toward the recent highs and the entire conversation changes from is silver breaking down to is silver beginning the next leg. Scenario 2, the ceasefire optimism fades, oil reverses, and the market realizes the straight situation is still not fixed. In that case, silver can open heavy and the mid-$70s become vulnerable. If silver starts losing support while oil is rising, that is not a random dip. That is the market pricing a more hawkish Fed path and deeper stagflation pressure. In that scenario, you do not want to be emotionally reacting to every candle. You want to watch oil, the dollar, and treasury yields, because those will tell you whether silver is selling off because of silver-specific weakness or because the macro pressure is back. Scenario 3 is the most frustrating but probably the most realistic. No clean resolution. A little optimism, a little doubt, some vague statements, no final deal, no full reopening, and silver stays trapped. In that case, the mid-$70s remain the battlefield. Bulls will argue that the downside is limited because supply deficits and industrial demand are still strong. Bears will argue that silver cannot break out while inflation expectations are rising and the Fed is boxed in. Both sides will have evidence. That is what compression looks like. It feels boring until it breaks. The next major scheduled catalyst after this weekend is the June 16th and 17th Fed meeting. That meeting matters because it comes with updated projections. The market is not just listening for the rate decision, it is listening for the tone. Does the Fed sound worried about inflation expectations becoming unanchored? Does it sound more concerned about slowing growth? Does it treat the energy spike as temporary? Or does it act like higher inflation is becoming embedded? That difference matters enormously for silver. If the Fed sounds less hawkish than the market fears, silver gets relief. If the Fed sounds like it is preparing the market for higher for longer or even more tightening risk, silver stays capped. Here is the cleanest way to think about it. Silver does not need perfection. It needs the pressure to stop getting worse. It needs oil to stop feeding inflation. It needs inflation expectations to stop rising. It needs the Fed to stop sounding trapped. And it needs the market to remember that the industrial demand story never went away. If those pieces line up, silver can move fast. If they do not, silver can stay volatile and frustrating before the bigger move arrives. This is why I do not want you watching silver in isolation. Watch oil first. Watch the straight headlines second. Watch the dollar third. Watch yields fourth. Then watch silver. If oil is falling, the dollar is softening, yields are easing, and silver is still not moving, that tells you something. If oil is rising, the dollar is firm, yields are climbing, and silver is getting hit, that also tells you something. Silver is the scoreboard, but the macro variables are the game. And this is also why emotional trading is so dangerous right now. The people who panic on one red candle are going to get shaken out. The people who chase one green candle without understanding the catalyst are going to get trapped. The edge is not guessing every tick. The edge is knowing which outcome you are seeing before the crowd understands it. Deal confirmed, oil down, yields down, silver up. That is a monetary engine restart. Deal collapses, oil up, yields up, silver down. That is stagflation pressure returning. No resolution, silver chops. That is compression continuing. Once you understand the map, the candles stop feeling random. So going into this open, my focus is simple. I want to see whether silver can hold the mid-$70s without needing perfect news. I want to see whether oil continues to price a real de-escalation. I want to see whether the market starts believing the inflation shock is temporary. And I want to see whether silver can push toward $80 with confirmation from gold, the dollar, and yields. If that happens, the entire tone changes. If it does not, patience matters more than emotion.